All right. I am happy to present our webinar today. I'll be talking about the blueprint for purchasing 5+ properties. For those of you that missed our last month's webinar, we talked about buying your first 5 properties. So if you wanted a copy of that, please reach out to us, and we'll be happy to send you a copy of that recording. But today we'll be talking about purchasing your 5+ properties and the difficulties and challenges that you run into when you reach this stage of your investing career. So welcome to the presentation. I'm glad you're all here, even though it is a beautiful day right after a long weekend. So thank you for attending. And if you're watching this as a recording, then I'm hoping that you're watching this at your leisure. So first, let's go into the table of contents. I'll be talking about buying your first 5. So I just want to do a very quick recap of what we talked about last month. I want to talk a little bit about the planning part of things and how important it is to plan when you're building a real estate portfolio of 5+ properties. Talk about the key core professionals that you need involved in your investing career. We're going to be talking about incorporating or not. Really common question that comes up, and something that frankly is very difficult to answer. When you talk to 3 different accountants, they're all going to tell you it depends. So I don't like that answer. I want to give you a little bit more clarity on the pros and cons and why you should consider or should not consider incorporating. I'll talk about your personal finances and how to set those up in order to be able to buy as many properties as possible. And how lenders qualify rental properties is really important to understand how they do it. Once you understand the game, then it's easier to play it. I'll talk about the 4 most common challenges that you run into when you're getting into the 5+ properties, and 3 different solutions that we've come up with to solve those. And then we'll talk about upcoming webinars and upcoming seminars that we're doing. So as I mentioned, our last webinar was all about your first 5. So we really talked about buying your first residence, buying your first rental, and getting up to 5 rental properties. I'm going to do a quick recap of some of the things that we highlighted and where we got to on that. And then we're going to talk about how to go into the 5+ section and getting into the 5+ and also commercial lending. So first of all, a quick summary on buying your first 5 properties. The first thing is always to make sure that you plan. I like to say, and this is not my saying by any means, but if you fail to plan, you plan to fail. So it's really important that you structure a plan. Even if you're only buying properties 1 to 5, you still need to make sure that you have some kind of game plan in place, or else it's very, very difficult to keep building that real estate portfolio. Another really important key here is also looking at getting a home equity line of credit on your residence. If you own your own home, you should be making sure that you get a home equity line of credit on it. We've done a number of webinars about the tax benefits of doing so and how you can leverage the equity in your home to be able to borrow against it to actually invest in real estate. And I'll talk a little bit about this later today, because you may have heard some talk about some HELOC rules changing as of next year, and that will affect some of our investor clients. And the last thing I want to talk about too, and the quick summary, is that you need to structure your income properly, especially if you're self-employed. It becomes more and more difficult for you to buy properties as you continue to grow the portfolio, because the lenders only use a certain percentage of the rental income to help you build your real estate portfolio. I'm going to show you a slide that we used near the end of our last presentation, and this is buying your 4th and 5th property. So if we assume that every rental property that you bought was a $500,000 rental property and generated $2,500 a month in rent, by the 4th and 5th rental properties, you need an household income of between $150,000 and $220,000, assuming that you're getting a 30-year amortization on all of your loans and all of your debts. And by the way, this is assuming too that your residence is only a $500,000 property with a $400,000 mortgage. If you have a $1 million mortgage on your own residence, you need even more income than this. In general, it's very difficult to build a real estate portfolio, and we're going to talk about some of the key points and go into a bit more of the math on why it is difficult to build a large real estate portfolio. But I just want to give you a couple of the key points that we talked about at the end of the presentation of buying properties number 4 and 5, because we're going to go past this and eclipse this and get into it in this presentation. But one of the keys is that lender guidelines will vary and will stack with more properties, meaning that let's say the lender uses 50% of the rental income to help you build a real estate portfolio. Well, if they're only using 50% of the rent, if you have 1 rental property, that's probably a small rental shortfall the lender's factoring in. But if you have 5 rental properties, now that's a large amount of debt that you're carrying. And again, the lenders don't use all of the rental income to help you qualify. So as you have more rental properties, the negative downsides stack on top of each other and make it more and more difficult and challenging for you to continue to grow your real estate portfolio. Something called a DCR becomes more relevant in some cases, depending on the lender. I'll be getting into what a DCR is and what it means. But a DCR becomes way more relevant for you, especially when you're in the 5+ realm, because of the way that lenders start to look at you as an individual client. Liquid assets are put under the magnifying glass now. So usually once you get up to about 3, most lenders are okay without a large number of liquid assets. But then you start getting to 4 and 5, and now you're going to see that there's a bit more magnifying glass on those liquid assets. It becomes more of a challenge for you to be able to continue to grow the real estate portfolio unless you have a lot of assets that are liquid. So that would be stocks, bonds, mutual funds, et cetera. And I know a lot of you are here because you really want to invest in real estate. Trust me, I get it. I'm the same way. But it is important for you to diversify as a, from a financial planning perspective, it's really important for you to do so, but also just for the lender's perspective too. It's important that if you do have a few things coming up all at the same time, you should have some liquidity to weather that storm. Another key point I wanted to make sure that you're aware of too, is that when you're getting up to this level, this is where you're going to start to hit a bit of a wall. A lot of lenders have a 5 max property rule. And this is where people start to run into a challenge where either their own bank, they thought they were good and they continue to buy real estate. And all of a sudden they're hitting a bit of a wall because the lender says, sorry, can't help you because you have more than 5 properties. This becomes more of an issue. Some lenders have a max 5 in total, some are max 5 with them. But this is a really important guideline to understand in order to be able to break through the 5 property barrier. So we've talked a little bit about getting up to your first 5 rental properties. Now I want to focus on the 5+ and looking at also evolving into commercial. So in general, most of our clients start off by buying residential properties to build their real estate portfolio, and eventually they start to look at perhaps moving into commercial real estate. I'll talk about that a little bit later in the presentation. So planning, if you want to be purchasing properties 5 to 10, there's a lot of planning that's involved. It gets more complicated. It's not as easy as just going out and buying one property. You definitely need to start doing things like defining what your goals are, speaking with professionals about what your plan should be, and then obviously initiating and executing on that game plan. So it's really important that you start to think about this and figure, okay, where do I want to be in 5 years? I often find a lot of investors that are new to investing in real estate don't really know where they're going to take it. We might ask that question. They might say, well, I might want to, buy this one for now and we'll see how it goes. Now that you, if you're at this mark and you have 5 under your belt, you might be starting to think, well, okay, 5 is great. Now I feel like I have a better understanding of where I want to take it. I do want 10 or I want 20 or whatever the number is. The more clearly defined your goal is, the easier it is to execute on a game plan. And one of the things you're going to find is that you're going to be leaning a little bit more on some of the core planning professionals when dealing with this. If you haven't really dealt with a lawyer a whole lot, you're going to find you're dealing with lawyers a lot more at this stage of the game. Some of the things that are starting to come up are liability protection. You have a much larger real estate portfolio, a lot of assets under your control. Trying to figure out ways of protecting those assets from liability becomes more relevant. Also, we need to start looking at some of the corporate structuring, and that's when we talk about incorporating or not. Lawyers are a very important piece of the puzzle when you're looking at that. And also estate planning as well. There are some benefits to structuring things in company names from an estate planning perspective. And so these are some of the things that start to come up with a lawyer when you have 5+ rental properties. You start thinking about this stuff a bit more. When you're buying your first or second rental property, these are not things that usually come up. Accountant, this is a big one too. There's a lot more tax planning that starts to come into effect here. Also, if you're self-employed, there's a lot more income planning as well. The lenders are always looking at what is your taxable net income on your tax returns, and needing to make sure that you're always inching this up so that you always have a surplus of income that can be used for servicing your debts that you continue to grow is really, really relevant here. And so we work with a lot of clients and their accountants to figure out what should your income taxes be when you file your income taxes. And in addition to this, the accountant's also a very integral person involved in the estate planning aspect as well. So a lot of time, especially when it comes to incorporating or not, It's both lawyer, accountant, and often mortgage broker as well that's involved in that conversation. And obviously with the mortgage broker, you're looking at, what are my qualifications? How much do I qualify for? Which lenders can I talk to? It becomes way more challenging as you grow your real estate portfolio to find lenders that will lend to you, as every lender has a different box that you need to fit into. And in general, the more variables, aka the more properties you have, the more difficult it is for you to fit into a specific box. That's often where clients often will go to their own bank and they'll get 3 or 4 mortgages, no problem. Eventually they hit the wall and they find out that, oh, I can't qualify, my bank said no. And we may look at that file and say, you know what, you can qualify 4 other lenders, you just don't fit with your bank anymore, but you fit with a few other banks' boxes. And so we talk a lot about the income planning, but also the proper lender selection aspect. And so we do look at, which lenders do we want to use first, which lenders do we want to use later on. That becomes a more integral piece for those clients that are looking at buying, up to 10 properties or even more than that. So I do want to talk about one of the big questions that comes up, which is incorporating or not. I get this question pretty much every time I do a presentation. I'll do a presentation about first-time home buying, and one of the Q&A questions that comes up is, hey, Kyle, should I incorporate or not? So it's a very common question, comes up all the time. And the quick answer is, it is complicated. It is not easy. It has a lot of moving parts. I'm going to do my best to explain what the differences are and why you can consider it or not consider it. And this may help you make a decision. So first of all, just to understand how you can buy real estate. First of all, you can buy in a personal name. This is the most commonly way that people purchase real estate. You can also buy in a holding company or an inactive company. A holding company is a company that holds assets and earns passive income. Or you can also purchase real estate in an operating company as well. This is a lot harder to do, but this is another option. You're going to find that buying real estate in an operating company name is a lot more common with commercial financing. So somebody buying their own owner-occupied space and getting a commercial mortgage against their own space. If you make widgets and you're buying a industrial space in Vancouver to make widgets, then you would often put that in an operating company name or a holding company name. Where your operating company is just occupying the space and leasing it from your holding company. So lots of different structures there with the corporations and how you set those up. But in general, it is very difficult to get financing in a operating company name. So if you're looking at personal name, in general, this is where it's easiest to get financing. In most provinces, except for Alberta and I believe Saskatchewan, it is easier for a bank to foreclose on a person than it is to foreclose on in a company. And so you're going to find that most banks prefer to do it in personal names. It's also just less paperwork. They don't have to go through the articles of incorporation and all of your corporation documents to determine whether they should be lending to you or not. And so you're going to find the best financing usually is for personal name financing. The tax rate for an individual varies generally about between 20 to 50%. The average tax rate in Canada is about 41% tax. And so that's something that you need to keep in mind when you're looking at this, because this is often a tax question, and it's also a liability question as well. A holding company is a bit more difficult to get financing in a company name. Generally, you're looking at higher rates. Sometimes fees will apply, or just a smaller subset of lenders that will lend to you. And the tax rate, and it may be a little bit higher than this now, but it's about 50.7% tax. I've heard recently somebody mentioned 52%, so I'm not sure if it's gone up a little bit, but the tax rate is a little bit over 50%. So the tax rate is higher in a holding company than what most people are paying on a personal basis. And then an operating company, which is almost impossible to get residential lending for an operating company name. There's one company or one lender that may consider it, but most lenders will not lend to an operating company. And the operating company tax rate is lower. So this tax rate varies depending on whether you're considered a small business. So I believe if your net income is under $500,000, then I think the small business tax rate is about 10.5% today. And I think if the revenues are over 500,000 or the net income is over 500, then I think it's closer to 15%. But long story short, an operating company is a lower tax rate. However, from a risk management perspective, if you're selling goods and you could be sued for what you do, you probably wouldn't want to hold real estate assets inside of the operating company, because then if you do get sued, then those people can go after any assets held inside of the company, which would include your real estate. So it's very uncommon to see real estate holdings or other holdings that are not inside of a or holdings that are inside of an operating company name. So this is a fairly complex structure, but sometimes this is as deep as some people will get. So you have an individual, and this person has a real estate holding company, a cash holding company, a real estate consulting and management corp, and an operating company. Now, to make things simple, sometimes these people will only have themselves, and they'll have an operating company, and they'll have a real estate holding company. So they may have something that's a bit more trimmed down, but sometimes it can expand into something this expansive. So this is what we often see, and the primary reason to buy in a company name is if you own an operating company, because what happens is you usually flow your money up into your cash holdco from your operating company. So it flows up to the cash holdco and then to you as an individual. And so instead of you paying yourself from either directly from your operating company or from your cash holdco to yourself, instead what people often do is they instead pay their real estate holding company, and they'll move the money over. And the reason for this is that if the cash stays inside of the corporate structure, then you're never taking the money home and paying that high personal tax rate on it. So if you're earning an income instead of the operating company, and then you just pay the operating tax rate on it, and then lend the money or move the money over to the real estate holdco, well, now you're avoiding paying the personal income tax on it. So you're effectively kicking the can down the road. You're going to end up paying the tax later on, or you're going to be paying it on a higher tax rate because the holding company tax rate is higher than a personal individual in many cases. However, this is one of the main reasons to do this, because if you only paid the operating company tax rate of 10.5%, if that was on $100,000, well, now you have about $99,000 or $89,000 left over to use for down payment on an investment property. If you took that same $100,000 from your operating company and paid yourself directly, and your tax rate was at 40%, well, now you only have $60,000 left over to invest in real estate. So you effectively are investing pre-tax dollars when you have this kind of corporate structure set up. Now, to make things more complicated, some people also will set up a real estate consulting and management corporation, and they effectively invoice the real estate holding company for what ends up being the net income of that holding company. Now, this is a more complex structure, and the CRA doesn't seem to be too favorable on this. I know that if you speak to different accountants, there's different rules and guidelines. Some of the rules that I've heard is if you have 5 employees in your operating company, then you're definitely deemed to be an operating company. Or if you're conducting active work for that work, then it might be something that's deemed doable. Because otherwise, this is just a fancy way of shifting that money that's earned instead of the holding company at the higher tax rate into the lower tax rate of the operating company. So I'm sure that you're sitting here and a lot of you are thinking, okay, that was quite confusing. I don't really understand if I should be incorporating or not. So I guess I'll just hang around and ask a few accountants perhaps. Okay, let's just go and look at the pros and cons here and try to make it as simple as possible. You should consider incorporating and setting up a corp to buy your real estate if you already own an operating company already. If you're looking at going with large scale with it, there are some benefits to having your real estate held in a company name. If you're going at scale, it's easier for you to sell shares in your company that owns the real estate later on if you need to create some more liquidity for yourself. It's better for estate planning in many cases. And so there are some benefits to setting up a corporate structure. On the downside, however, you're looking at about $1,500 per year per company to set up and do the ongoing legal requirements to make sure that your company is standing with whichever government entity you're registered in, so whichever province you're in. In addition to that, the accounting fees. So you're looking at least $1,500 per year just to keep the companies up and running. And it is harder and more expensive to get the financing. And something that I should mention too is that residential lenders do not lend to multi-tiered corporate structures. So what do I mean by that? If you have a holding company that's owned by another company and you want this holding company to own the real estate, it's very difficult to get the lender to do that because the holding company that they want to finance should only be owned by the borrowers. And so when people start to get more complex with things, they're trying to get residential lending, it can be very difficult. In theory, you should say, well, if this company is owned by another company, then why don't you just go all the way up the chain to see who ultimately owns the companies? And that's something that small business lending and commercial lending can consider. But in general, that's not something that that residential lenders will do. So it can be more difficult. So at a high level, if you're planning on about 5+ rental properties, maybe worth considering going with incorporating, because you're going to be operating at a large scale. Or if you're already incorporated already and you have an operating company that is earning a surplus amount of cash that you'd like to invest, that's the other primary reason where it really makes sense for you to set up a corporation. There are lots of other little nuances and other reasons, but these are pretty much the primary two: scale, and if you already own an operating company. These are the reasons that you would consider. So understanding whether you should be buying in a company name or not is really important. The other thing that's really important too is making sure that your personal finances are set up in a way where you can qualify for this mortgage. And in general, as you expand and grow the real estate portfolio, the income requirements continue to rise. And here's why. It's because there's 3 primary methods that lenders look at when determining how much you qualify for. So most lenders use something called a 50% add to income method. So if I assume in this case that there's $1,000 a month in rent on a rental property, most lenders will take 50%, so $500, add it to your income, and then they usually want only about 40% of your income to be used towards your debt servicing. So they're really only using $200 of the $1,000 a month in rent. So you can imagine how this would be very difficult for you to qualify for 1 or, heaven forbid, 10 properties if they're only using a very small percentage of that rental income to help you qualify. There are lenders that use something called an offset, and the number varies depending on the lender. We've actually had a few lenders recently that have cut back on the rental offset that they use. But an offset means that they use a percentage of the rental income, and then they offset all the expenses against that. So let's say that there's $1,000 a month in rent, and they're using 80% offset. They would use $800 of the rent, and they would offset that against all the expenses first. And then if there's a shortfall, then that's a liability, or if it's a surplus, then they add it to your income. In this case, out of the $1,000, they're really using $800 of the rent instead of, in the first example with the 50% add to income, only using $200. So an offset is significantly better than an add to income method when determining how much you qualify for. The last one that I wanted to talk about, and I did allude to this earlier, is a DCR, which stands for debt coverage ratio. And this means that the portfolio and the property itself needs a 1.1 or a 1.2 DCR. So that means that the income to the expense ratio needs to be 1.1 or 1.2. And so they're looking at all the expenses. And by the way, they use their own expenses. So they might use 5% vacancy, even though the market that you're buying in only has 1% vacancy. They're going to be using certain expenses for insurance and things like that. And not to mention, this is probably the big one, because back in 2016, they introduced the stress test. And now, in order to be able to DCR a property, it's very difficult because they have to use the stress test interest rate, which is 2% higher than the actual rate that you're getting. So that the lenders want you to be able to cash flow the property positive with some extra money in your pocket, using a rate that's 2% higher and using a bunch of expenses that are not really relevant. So one of the good things about the DCR is they're using all the income, but it must be a surplus. The downside to the DCR is that it's very, very difficult to get 80% or 75% leverage. A lot of the time when we're looking at a DCR, we're only able to use, get a loan to value of 50% or 60%. I actually had a client, I think it was last year, buying a couple of condos. He owns a lot of real estate. It's about 13 properties I think he owns. Very strong net worth. His net income on paper is over $1 million a year. His net worth is in the tens of millions of dollars, but only one major bank would give him financing, and they had to use a DCR, and they would only give him 35% financing on the 2 condos. So the condos are about $500,000 purchases, and we were only getting about $150,000 in financing from the bank. So you can imagine how difficult and challenging it can be, even for very strong applicants, when you're using a DCR, debt coverage ratio, unless you're buying in a really small market where the rent to price ratio is really good. So where I'm finding the DCR is not a bad fit is clients buying properties in the Maritimes, for instance, where the rents as a function of the prices are much better than they are in, let's say, British Columbia. So some of the issues that you're running into is just the size of the portfolio. In general, over 5 rental properties is tough. Less lenders are willing to do this. One thing that we come up with a lot, especially when we're going over the client's game plan, a lot of clients say, yeah, I'm going to buy 5 properties, I'm going to buy a few properties, and then I'm going to quit my job, I'm going to buy even more. And the problem with that is that professional landlords are not okay on the residential side of building the real estate portfolio. They have larger liquid asset requirements once you start to get to a certain size, which makes it harder to keep growing it. But in particular, being a professional landlord, very, very difficult for you at residential lending. Another challenge is just having a low income. The stress test at 5.25. In fact, with current interest rates, most clients are actually stress testing at even higher interest rates today. A lot of 5-year fixed rates are at or above 5% right now, which means the stress test rate is actually over 7% right now, if you're taking a fixed rate. There are requirements for the government to make sure that these deals are income qualified. Back in the day, it used to be really easy to get mortgages. I've been doing this for 15 years, and I remember a funny story where TD, the CEO of TD, was asked how many of their mortgages are done without income verification. And he said about 5% of the mortgages are done without income verification. Turned out the government audited TD Bank, 55% of the mortgages were done without income verification. So this is back in 2012, after the subprime crisis, I must add. We used to be able to do deals where if you're doing a deal with TD, owner occupied, 35% down. If you didn't owe CRA taxes or anything, slam dunk, done deal. If you're doing a rental property, then sometimes they would want 50% down, but then they wouldn't ask questions. Nowadays, it's not about the down payment percentage that determines risk. The government is auditing banks to make sure that there's enough income. They don't want people being able to qualify for real estate just because they have enough equity in the property. So this is something that can be a challenge. Now, one of the ways to alleviate a low income on a file is some lenders have net worth or self-employed programs that can help alleviate these issues. So some lenders will say, okay, you have $1 million in mutual funds. We'll add that $1 million to your borrowing power to help you grow your real estate portfolio. In most cases, however, most of these net worth programs are only for owner occupied. We do have 1 or 2 banks that will consider doing it on rentals, however. The other program we've been using a lot is something called corporate net income. So those of you that are incorporated, we can use this percentage of your incorporated, if your corporate net income. So if your company made $300,000 and you only took $100,000 home as salary dividends, and you left $200,000 in the company as net income, we have lenders that can use a percentage of that net income as if it was your take-home income. So there are some special programs available for those that show a low income, but really can still service those payments. The other thing you're going to come up to a lot, complexity. Doing deals in company names, especially multi-tiered corporate ownership, holding properties in trust, things like this that are more complex. I won't get into the holding in trust thing today, but a lot of things like this are very complex and can make it a lot more challenging to get financing. So on the personal finances side, it's really all about debt servicing, focus on cash flow real estate. Take 30-year amortization on all of your debts, even your residence. You can make lump sum payments on your mortgage on your residence to pay it off faster. But if you have a 30-year amortization on your residence instead of, let's say, a 15-year amortization, that could be the difference between you qualifying or not qualifying for a rental. The other thing that's really important is to eliminate all high interest debt. So a car loan where you owe $25,000 on it, but it has a $550 payment, is the same as borrowing $100,000 in a mortgage. So often step one with a lot of our clients, if they haven't been investing for a while, is a bit of a cleanup. We'll do a debt consolidation using the residents to pay off all of their debts, re-amortize their debts, lowering and creating a better debt servicing platform. And then we can go out and buy more rental properties. So getting a HELOC is usually step number one, as well as wrapping up and rolling all of that debt into it. Also important to follow the game plan. If you fail the plan, you plan to fail. And if you're self-employed, chat with your accountant and broker annually to determine what income should be claimed on your taxes. So lots of things to think about with regards to setting up your personal finances the right way. So you might be feeling good. You might have been able to, buy a couple properties. Things are working out for you. Why is Kyle talking about how difficult this is? It's not difficult at all. I'm feeling great. Well, just wait until you've been declined. Here's what your bank's not telling you when you all of a sudden, boom, you hit the wall. Now you're frustrated. You're trying to figure out, what do I do in order to break through this? So let's talk about the four most common 5+ rental property challenges. The first one, we talked about a little bit, low personal income. So professional landlords, those that are self-employed, this is one of the most common issues that we see. Portfolio cash flow. We see some clients that have too many speculation holds or development plays. So people buying $2 million homes in Vancouver that rent out for $3,000 a month, because eventually you might have a land assembly and you're going to make a really big profit on the sale of that property. It just makes it really tough for you to buy more real estate if you're buying too many properties that have a very low rent to price ratio. In that example, $3,000 a month on a $2 million property, the monthly rent is only 0.15% of the value of the home. That's very, very low. In general, if you're doing quick math, in general, you're aiming for about 0.4% of the value of the property in monthly rent, which means if you buy $1 million property, you want about a $4,000 a month income on it. If you're buying something for $500,000, you want at least $2,000 a month on it then. And of course, the more the better. With that metric, that doesn't mean that the lender is going to view that as a positive. In fact, that's probably still a negative according to their books. But it's just a good metric to look at, because usually with 20 or 25% down, you're usually pretty close to cash flow neutral on your own books, at least. Number of properties. So I mentioned this earlier, but a lot of lenders have a max rule, and that max rule is usually 5 properties total. Some lenders will say, actually, we're okay if we're going up to 10 as long as no more than 5 are with us. And so with that limited playing field, this is where we talked a little bit about structuring things properly and which lenders to talk to. These are some of the things that we start to think about with a client that wants to buy 10+ properties. Okay, which lenders should we use now, because they won't be good for us 5+ later, and which lenders do we want to preserve for later? And then liquidity. In general, you want to be targeting about 30 to 50 grand per property as you build your portfolio. I find that this is a number, and a lot of lenders don't have a black and white number on this, but the gray areas tends to be around the $30,000 to $50,000 per property when they start to look at the liquidity. So that's a good target for you to have. Now, of course, those are all the challenges, and of course, there's always solutions. Where there's a way, we'll find it. We'll break through that wall, especially if it's 1 centimeter thick. Now, one of the methods that we look at here is proper lender selection. The max number of properties total, the max number of properties with that lender, and also aggregate lending amount with that lender too. That's in the other factor that they look at. How much money do you have owing with that lender in total? And so we always look at using the lenders that don't do 5+ properties in the beginning, so we can preserve that small handful of lenders that do 5+. And it keeps as many doors open as possible for you, because if you do intend on buying up to 10 properties, it's really important that we save those small handful of lenders available for 6 to 10 as possible. If you're burning 1 or 2 of the bridges early because you're using the wrong lenders that really should have been preserved for later, then that's not going to help you a whole lot. One of the things that we do when we're determining the lender selection is I spent countless hours creating a very, very comprehensive worksheet that allows us to punch in the client's details into one spot, and it actually spits out all the debt servicing numbers, the DCR levels, et cetera, with all of the major lenders that we deal with. And so it gives us a really good handle of which lenders we can go to and what your shortfalls are, surpluses are, and we can do a really in-depth analysis on which lenders the client might fit with. And it's very simple, actually, because instead of usually having to provide us with all of your paperwork, we can actually send you just an input spreadsheet. You can type in the inputs into the spreadsheet, and we can input it into our master sheet, and it'll tell us whether we think we have options for you or not, without you sending us your 200 pages of documents, which has saved us a ton of time, and it saves our clients a ton of time too. And very quick question, 5 properties. Most lenders are not door-based. Most lenders are properties or titles-based. So it's something to keep in mind. Now, another thing I want to talk about is commercial lending and what the difference is. So what is commercial? Commercial would be if it's residential, but it's 5+ units on one title, then that is considered a commercial mortgage. retail, industrial, development, etc. Basically anything except for 4 or less units residential is considered a commercial mortgage. And so these are deals that that are underwritten differently and they're reviewed differently. And the lenders look at what's called the DCR, the debt coverage ratio. So typically they would want to see that the income is 1.25 times all of the expenses. And so ensuring that you're able to buy properties where if the current operating expenses are $50,000 a year, they would lend to an amount where your mortgage payments do not exceed $50,000 a year if the income is $125,000. Now, we actually developed a spreadsheet which we can send over to you if you're interested in receiving a copy that helps you analyze a potential commercial property acquisition, because it will help you reverse engineer what the maximum amount of financing that you can get on a commercial asset is. We do this analysis all the time. I had a client that we worked on one last night, actually. It was a multifamily property in BC. And it's one of these properties where the current rents are under market, and it can be very difficult to get bank financing on these types of deals. But we ran the analysis on it, and with the current income as it stands, the property would only be able to get about a $600,000 or $500,000 mortgage, and the property was worth about $2 million. So only getting about 25% loan to value. We also then, however, can look at, well, what if you normalize the expenses? What if you're able to trim down the expenses? And what if you can increase the rents by maybe having some tenant turnover, getting them re-rented at current market rates? And then we can also do the analysis at normalized or stabilized. And we could see that the mortgage would extend up to about 800 or maybe 850 if we were able to spruce up and get the income up by getting out tenants that are under market and getting new tenants that are at market. So we can do this analysis, and this is where commercial lending is very different than residential lending. This is where we would look at, okay, how do we structure things to be able to grow it and to be able to build it. And one of the things, thank you, is actually I was going to parlay into this too. You can also do blanket mortgages with commercial lending as well. And so you can blanket or inter alia it over a portfolio. So sometimes we have a client that has 8 or 9 rental properties in their personal name, all clogging up their personal borrowing power. And we can actually get a commercial lender to come in and blanket all of them and give them one commercial loan to take out all of it. Now, keep in mind, the biggest challenge usually is that your rates are going to go up on all of your debts. And in addition to that, you're also going to, in most cases, see that the loan to value will be restricted. And so if you have currently 80% financing all of your residential real estate portfolio, it's very difficult to get the same loan to value with a commercial lender. In most of the analysis that I do today on purchases, it's like 50% loan to value or less on most deals. And so it usually works best with clients that have had a portfolio for a long time, have not been extending and increasing their credit on their current portfolio. And this is a good way to just wipe everything clean and get it off the books, because once you have a commercial loan on those assets, that no longer reports to your personal credit bureau, because this is now a business loan. And so this is a major key and a major difference that we're finding. Now, on the commercial side of things, another note that I want to make is that small business lending is a hybrid of residential and commercial underwriting. And certain lenders are closer to the residential side for their underwriting policies, and certain lenders are closer to the commercial lenders for their underwriting policies. But small business lending is an interesting little niche that fits right in between. And frankly, most people don't even know it exists. I'm sure many of you are like, what is small business lending? I've never heard that term before. But we're actually finding that probably about 10% of our total book is now getting funded with small business lending, because it's a unique little spot where the guidelines are different. They do not have to follow the B20 guidelines and therefore the stress test that you have to follow with residential financing, by the way. They can use debt coverage ratio financing to make a deal work. They can look at your corporate net income to help make a deal work. They will do deals in company names. They will do deals in some cases. Most of the lenders go up to 75%. We have a couple of credit unions that consider up to 80% financing for small business. And most importantly, these mortgages are business loans, and so they do not report on your personal credit bureau, so it can make it easier for you to continue to grow your portfolio moving forward. So we've been finding that the commercial and also small business lending has often been a way of propelling things forward and being able to continue to build the real estate portfolio. A lot of our clients that have 5 or 6 or 7 rental properties are finding it's just so difficult to get residential lending. They're turning around and say, hey, you know what? Me, you, and a couple other people, let's just team up and let's just buy an apartment building together. We have enough capital to do that, or maybe sell off a couple of the residential assets and just buy one larger building. This is something that that is a lot more common when you start getting into commercial. And when you're doing commercial financing, they do start talking about doors. Residential lending, you're going to hear titles, but when you're dealing with commercial lending, the terminology usually is doors. So on joint ventures, this is another way of continuing to build a real estate portfolio. And I usually find that there are usually about 4 different ways that you bring value to a joint venture. There's the cash partner, there's the managing partner, there's the deal finder, and there's the qualifier. And each of these people have different different values that they bring to the equation. I find that you know, a lot of people say, well, what percentage value is the deal finder? Well, if the deal finder found a deal where the property is worth $2 million and they've got it under contract for $1 million, then I would venture to say the deal finder is worth a lot in that case. If the deal finder found a deal that's 50 grand under market, then maybe they don't have as much value in that particular circumstance. So I really say to everyone that this is very fluid and it really is up to negotiation. There is no specific mathematical formula for who is valued at what percentage when you're doing a joint venture. But I do recommend that that you consider joint ventures if you're starting to get into a period where it's getting harder and harder for you to get residential lending. So, you know, I want to tell everyone that anyone can do it. Joint ventures are very doable. I did my first joint venture when I was 21 years old, and I did a $1.15 million property, and I put no money into it. I actually brought the investor in, and the investor put all of the cash into it. And the reason that we did this is because the property is worth 1.15 million. It was about a 3-minute walk to the beach in Kelowna, and the monthly rental income was $7,600 per month. So, you know, very, very solid deal, and the investor was very happy with I think our net income was about $3,000 a month. Now, I need to make sure that everyone understands it's very important to get a joint venture agreement done. It doesn't matter if it's your neighbor, your family member, or somebody you've never met before. Get a joint venture agreement done, engage a lawyer, make sure this is done properly, and make sure that you discuss everything in advance to make sure that everything is clean and concise up front. Another key thing that I want to mention is the qualifying partners, person getting the mortgage must show that they have the down payment. This comes up all the time where you say, hey, I have a silent partner that's paying for the cash. I'm going to qualify though. It's like, well, if I'm trying to qualify you as a borrower and you have no down payment, the bank's not going to accept a down payment coming from some random person that's not on the deal. So very important that you understand the qualifying partner, the person getting the mortgage must show that they have the down payment. Networking is key. You know, sometimes we have people say, hey, Kyle, I got this really cool deal. Can you help me find a partner? It's like, well, I might be able to, but frankly, it's a lot easier for you to find somebody that you know, like, and trust. And so this is where it's really important to be really involved in networking groups, and there's lots of different real estate groups across the country. So it's really important for you to get in there and get involved. And it's really important to, like any business or partnership, find a partner that has different strengths than you. If you're both really good at finding deals, but neither of you have any money, then you should probably find another partner that does have some money, right? It helps to find somebody that can offset some of your weaknesses so that then you can find a good joint venture that works together. And it's just like building a business. You don't want a ton of people that are really good at one thing. You want a nice diversification of strengths and weaknesses inside of the business. So just remember, game plans will vary person to person, and a game plan for 5+ properties is very different than a game plan for somebody that just wants to buy 1 property or 2 properties. So the plan is very, very important. And you need to think about this and understand where do you want to take this. And sometimes I know that the plan changes, but the more foresight you have on where you want to take things, the easier it is for you to plan. So this may have sounded very complex. There's a lot of high-level things that we went over today. If you want to hit the easy button, then you can obviously book a consult with us, and one of my team members will be happy to discuss things with you and go over things with you to help structure that game plan with you and help you. Often by closing some doors, we say, look, maybe some of these options or ideas that you have are not financially doable. So let's close those doors, give you some laser focus on the things that you can do, and now you can actually get to it and execute on a game plan. We do have a cash flow analysis spreadsheet. So I have one for residential financing to do an analysis. I also have a commercial lending one as well that will calculate the DCR. I saw one of the comments in the chat was asking for that. So if you email us at info@greenmortgageteam.ca, then we will happily send you a copy of the spreadsheets. And ultimately, all of this information and knowledge doesn't do anything unless you turn it into action. So it's really important that then your next step is, okay, let's go out there, let's figure out what the game plan is, be very clear and concise with it, and let's go out and see if we can buy properties that fit that plan. Another thing I want to mention too is that about 2 years ago, I set up a real estate consulting company called Greenwealth, and that's for those that want to take this a step further and really treat this like a business. And so we do a lot of holistic planning where we actually engage and we get the accountant and the lawyer and the client and ourselves in on one call to make sure that the game plan is very clearly hashed out so everyone's on the same page, making sure that they have a really clear understanding of how to set up their insurance and even property management, helping do joint venture setups and partnerships, et cetera. And really just working on the primary thing is helping people create a game plan and educating our clients on how to build a real estate portfolio. We actually are having a seminar coming up in September. We have not finalized the date because there's a lot of other events that are happening in September as well, but it's likely going to be the weekend, I think, of the 24th of September, that we're likely going to be doing a 2-day or 3-day workshop. And we'll be deep diving into creating game plans, analyzing properties, how to do a quick analysis on a deal, how to do a commercial analysis, how to look at a property and know, hey, it's underperforming today, but what would it look like if I was able to restructure it and improve the asset? What would it look like at that point? How much would the value go up by, and how much would I be able to finance on it? And we also have our Green Mortgage webinars at the 7 p.m. of the first Wednesday of the month. If you do want more information, by the way, on the Greenwealth course coming up in September, just email us at info@greenmortgageteam.ca. And once we have the date locked down and a few other details, then we'll make sure that we send that over to you. And of course, we have lots of downloadable spreadsheets and tools. And I did write a book called Rockstar Real Estate Investing. This is primarily for those that are looking at getting their real estate investing career started. And so probably better suited for those that are buying their first 5 properties, for instance. But if you or somebody that you know would be interested in a copy, you can always email us at info@greenmortgageteam.ca, and we'll mail you a copy. Just make sure you put in your mailing address in the email so we know where to send it. Awesome. And if you have any questions, of course, you can reach out to us or visit our website at www.greenmortgageteam.ca. So I will now move into the Q&A section just to answer any questions that anyone has. I see there's one question in the Q&A, and then I'll move into the chat if there's no other questions in the Q&A. So the question from Gord. Gord, long time no chat. It's been probably over a decade. So can you qualify personally and move the property to a corp at closing? No. So the instructions from the lawyers or to the lawyers from the lender are going to say that the property needs to be registered in the personal name. And so moving it to the corp at closing is not something that is doable. What you might be hinting at here might be holding a property in trust, which is a bit more complicated. But holding in trust means that you go out and buy the property in a personal name, but you're holding it in trust for another entity. And so in theory, you can actually say, I'm going to buy this property personally, but I'm going to register and hold it in trust for this other entity, which would be a company that you perhaps own, and it's treated as if it was in that company's name in the future. This is something that we don't usually recommend. However, it can trip you up and make it a lot harder to get financing down the road. Awesome. Let me open up the Q&A again. Okay, so I'm going to go through the chat as well. I see some other questions here, so let me just open that up. Yeah, so there's a question or a comment from Mark that the experiences that they count doors. There's a few lenders that do count doors. Notably, National Bank is one of the lenders that counts doors, and a few others, but most lenders do count titles. That's usually how they look at it from the residential perspective anyways. Ryan Benson was asking if it's possible to get that DCR spreadsheet. Absolutely, just send us an email and we'll send you over the spreadsheet. Oh, Kate's already responded. Perfect. A couple of people wanted the spreadsheet. Another question here from Alan is the upcoming rules for readvancement mortgages. Want to confirm the detail not to take effect until your next renewal. Example of the new rules start in 2023 when I have 4 years left. They do not affect you for 4 years after 2023. Yeah, so let me talk about that. There are some new HELOC rules that have come out. Effectively, what they're doing is they are saying now you cannot re-advance up to 80% of the property value anymore. You can only re-advance a mortgage up to 65. So what that means is normally what we do for a client is we say, hey, let's get you a mortgage and a line of credit for up to 80% of the property value. And as you pay down the mortgage, you can re-borrow the money you've paid down on the principal up on the line of credit. So if you had a $500,000 property, we could get you a $400,000 mortgage. And as you pay down the mortgage down from 400 to 350, let's say, that means your line of credit limit has automatically increased to $50,000. So you always have in total credit available 80% of that property value when you bought it, which in that case is $400,000. That's 80% of 500. Now the rules now are that as of October of 2023 and moving forward, you will not be able to re-advance above 65% of the value of the property. So that means in that same example, they're only going to allow you, once you've paid down the mortgage down to only 65% and less of the value of the property, then you'll be able to re-advance and continue to re-borrow the principal that you've paid down on that mortgage. Now, here's the way that they're looking at it, is that this comes into effect in October of 2023, and it will affect mortgages when they come up for renewal. However, if you redo a mortgage this year, let's say, then you're only going to be affected by this new rule in 2027, if you took a 5-year term, when your mortgage comes up for renewal. And it's unknown how they're going to determine the value at that point, because they may pull up an assessment, for instance, from the municipality or the city to verify what the value is. There's a reasonable chance here that your value of your property has increased and the loan amount has decreased enough that you're still underneath that 65% threshold, and you can still continue to reborrow the principal that you paid down on that mortgage without needing to requalify. There's a couple of other loopholes, however, that we're starting to think of course. If you have a product like this and the value of the property has not increased, then you could, of course, just advance all of your money on your line of credit and then lock it in. And that way, at least all of that's locked in. And as you pay down those locked in mortgages, you won't be able to re-borrow the money back out until you're below that 65% threshold. But effectively, it just means that if you could, you usually or used to be able to go up to 80% financing, and as you pay down the mortgage, you could automatically bump it back up all the way up to 80. Now you're going to be stuck, going to be static. You cannot re-borrow it until you get to the 65 lever, and then at 65%, you can continue to re-borrow the principal that you paid down. So that's the biggest change, and that will be coming into effect in October of 2023. So there's lots of time. We do recommend, and I imagine we'll have a lot of clients that have renewals around that time, and even renewals that come up in November of 2023 or December of 2023 or shortly after. I have a feeling we have a lot of clients that are going to be redoing their mortgages, paying the penalty to do it a bit early before October of 2023, just so that they can still re-advance up to 80% of their property value. Let's see here. Any other questions? Jerry has a question. If you decide to incorporate for future purchases, would you suggest leaving existing portfolios in personal name or transfer them to the corp as well? Unfortunately, this will trigger additional land transfer tax. Pros and cons. Yeah, so there are two issues with you moving a real estate portfolio from the personal name into the company. The first one is land transfer tax. That is the first issue. The second one, which is probably even more expensive, depending on where your real estate is it's deemed a disposition. So you're technically selling it from yourself to another entity, and that means that capital gains could trigger. And the problem with doing this is that you're paying now a capital gain, but you didn't sell a property, so you don't have any cash to pay the capital gain. So it can be a bit of a challenge. There's something called a Section 85 rollover that you can talk to your accountant about. And it's a way that you may be able to defer the capital gains. And I believe that the way that they look at this is that if the ownership is the same, so if you own the properties personally and you set up a corporation where you are the personal owner of that corporation, you may be able to move it from your personal name into the corporate name without triggering any of the tax issues. So that's something to take a look at and talk to the accountant. I never get a real solid answer from the accountant on yes, it's definitely doable. They always say, oh, it depends. We have to look into it. So I think there may be some nuances or situations where you need to look at. But this is something that that you would want to consider is seeing if you can qualify for a Section 85 rollover. This conversation is probably a very large accounting question. You probably want to figure out how much tax are you paying right now to have them in the personal name versus how much tax you're going to pay to have them in the corporate structure. One other thing, Jerry, I've also heard that the Section 85 rollover might also allow you to defer the property transfer tax as well, but I'm a little less certain about that particular angle. Haven't had great data on whether that is doable or not, but you might find that it may be beneficial for you to do so. The way to potentially do that is to hold them in trust, because then the name on title does not actually change, but it can make it harder for you to get financing down the road. So it is a much more complex question than just a simple, should you do it or not? But high level, there's some things to talk about. Talk to your accountant about the Section 85 rollover. Denise has a question. Does a readvanceable mortgage make sense for personal residence or investment properties? So the readvanceable mortgage, the way that a lot of our clients use it is generally on the residence. Rental properties, it can make sense too, but there's less of a tax advantage. So in the rental property, the advantage is just being able to access the credit faster. So as you pay down that mortgage, you can reborrow the money back out and then use it to invest. But on a residence, the money you borrowed to purchase the property is not tax deductible, but any money you borrow against your residence to invest is tax deductible. And so what people usually do, Denise, is they'll borrow money against their residence for their down payment on the rental properties. So they're going to take the 20% down payment from the rental or from their residence, get an 80% mortgage on the rental, and combined, they borrowed 100% of the asset value, and it gives you a larger tax deduction. We've even had clients that have cash that they want to invest in real estate. It's better for them to take the cash, pay down their non-tax deductible personal mortgage, and then reborrow that back out on the line of credit, and then that's borrowed to use for their down payment on rental properties. And so it creates a tax deduction that you otherwise wouldn't have had. And so it is still nice to have a readvanceable feature on a rental property, but the benefit there is that if you're the mortgage on it right now is tax deductible anyways, and if you're borrowing against it again to continue to invest, that's tax deductible too. So there's not a differentiation between the two. What you should be doing is taking your residence, using every spare bit of cash you have to pay off your personal non-tax deductible mortgage on that, but then readvancing all the money that you pay down back out and then borrowing it to use for down payment on rental properties or to invest in other things. And you're accelerating and paying off the amount that's not tax deductible and increasing the amount that is tax deductible. And that's where you get the benefit of what is often called the Smith maneuver. And so, Denise, if you're interested in learning more about that, in the email, let us know that you'd also like a copy of the Smith maneuver book. I probably have 50 or 100 copies at our office, and it talks a little bit more about that strategy. Gord asks, is there a particular lender you suggest to get over 10 properties? Depends. Right now, CIBC is good for over 10. They will consider it, but they're using a DCR, so it's very difficult to get high leverage with CIBC. What I'm finding a lot of the time is pretty much every major bank at the residential level is saying 10 plus is just not for us. We're using a lot of small business lenders. So TD Small Business is really good. Coast Capital Small Business has been good for us. There's a lot of lenders that we've been using a lot, and their lending guidelines vary substantially. It's not nearly as easy as residential underwriting, but we've been doing a lot of stuff with small business lending. So that's probably my recommendation for the 10 plus. Kathy asks, if you were holding the property in trust for the company, will it trigger the land transfer tax if you're transferring to the legal title back to the company? So the land transfer tax only is triggered if the title changes hands. And so if you hold it in trust for another entity, the title itself does not change hands. You're now just holding it in trust for another entity. So as of now, there is no transfer tax that gets triggered if you just hold the property in trust from that date onwards, because it's not changing the title owner or holder. And Ricky's just mentioning, make sure to invest the money for the Smith Mover. Yes, so just to be clear, if you're wanting to reinvest the money and be able to write off the taxes, it has to be invested money. You can't just borrow the money to buy a new painting for your house. Denise has a question. So does a HELOC facility not used have a negative impact on debt servicing or debt coverage ratio? So with many lenders, or most lenders, yes. A lot of lenders a few years ago, back around 2018 or 2019, changed to using the HELOC limit, not the HELOC balance, in order to determine the debt servicing. So what I've been finding is the lenders I've been using a lot lately are primarily lenders that are using the HELOC balance, not the HELOC limit. Just because it's very important for you to have access to available credit so that you can invest. There are some little tricks and loopholes with regards to how to structure those so you have access to the credit, but it's not actually set up as a line of credit. It makes it a bit easier to be able to qualify in the future. But in general, if you have a HELOC limit, then most lenders will factor in the HELOC limit as if you were borrowing all the money. But there are a few lenders that we deal with that do not treat it that way. Cool, thanks, Mark. Good to see you. Cool. I think that's all the questions. Any other questions anybody has? I was able to answer everything. I know it's a very complicated topic here, and buying 5+, frankly, is just very, very difficult. It requires a lot more planning, and this is something that we specialize in. So, so feel free to reach out. We'd be happy to help you create your game plan and help you buy those next few properties. So thanks so much, and have a good night. Bye, everyone. And yes, there is a recording. We will email it to everyone that registered. So even if you did not attend, we'll be emailing out a copy of the recording. Thanks, everyone. Bye now.